Welcome to Barchart's educational webinar on the squeeze, a volatility indicator developed by renowned trader and author John Carter. In the world of technical analysis, understanding and effectively utilizing volatility can make a significant difference in one's trading success. The squeeze indicator offers a unique approach to identifying periods of low volatility and anticipating explosive price movements that often follow. With the ability to help traders navigate through consolidation phases and capture lucrative breakouts, the squeeze has become the go-to tool for many seasoned traders. Today, we'll look at the principles, the components, and the practical applications of the squeeze indicator, equipping you with the knowledge and skills to unleash the power in your own trading endeavors. So stick around as we explore John Carter's squeeze indicator. Hello, everyone. My name is John Rowland, Barchart's Senior Market Strategist. So powerful is the squeeze indicator that we at Barchart have incorporated it into our default template studies. And not only today will I explain the squeeze, but I'll offer some trading strategies John Carter himself employs when market conditions are right for one of these potential price explosions. Excuse me. Before we get to all of that, please welcome my partner and our moderator, Barchart's Project Director, Gene Baker. Hello, Gene.
Good afternoon, John. How are you?
I got a little frog in my throat this morning.
Oh no, gotta shoo that frog away. Get him out of there.
Ribbit?
Yeah, really. Yeah, so the TTM squeeze that you're going to cover today, it's a popular subject that I frequently see people emailing our support group about. So I'm sure that you're going to shed some valuable light on it for everybody out there and give us some more information to think about, right?
I think so. I think we're prepared in this one. And I know that a lot of the support guys like this indicator. And as I've been doing my homework on this one, I'm actually starting to become pretty fond of it myself. So, yeah,
Good.
you ready to get to it?
Let's get to it, Jen.
Great. So just a reminder, today's session is for educational purposes only, and decisions to buy, sell, or hold trade securities, commodities, or any other investments involve risks and are best made on the advice of a qualified financial professional. And under no circumstances shall we be liable for any losses or damages that you or anyone incurs as a result of any trading or investment activity that you or anyone else engages in, based on any information or material that you receive through barchart.com and or our services. Okay. So there are three types of indicators that technicians use. There's trend, oscillators, and volatility base. Now, trend indicators typically follow or signal after the fact. Oscillators can alert traders of extended trends or potential reversals, and volatility-based indicators recognize a shift in the change in volatility, which typically identifies the beginning of a trend or a price movement. Now, John Carter's is a famous author and trader who combined two volatility indicators with an oscillator to help him identify when markets are in these periods of low volatility, with the understanding that markets cycle from low volatility, gathering energy, to high volatility when prices move dramatically. So in his book, Mastering the Trade, he names this indicator the squeeze. Now, the squeeze identifies these periods of low volatility and aims to help traders position themselves before price explodes. Now, the name comes from the idea that markets cycle from low to high volatility. And during these low volatility cycles, energy is being built up, just like a coiled spring waiting to be released, as Carter calls being squeezed. And when the indicator fires, that release of this energy, price movement typically accelerates away from the tight trading range in one direction or another. Now, the components of the squeeze, well, Carter combined two components. One was a Bollinger Band, and a Bollinger Bands are based on a upper and lower standard deviation from a moving average. And Keltner Bands, or Keltner Channels, which are defined by an average range of price over a certain period of time. Plus, Carter uses a momentum histogram, similar to what you would notice if you were using, let's say, a MACD oscillator. Now, the oscillator is used to estimate the direction, the velocity, and also to alert of potential turning points. So how do we use or work these in tandem, and how do we understand it so we can utilize the squeeze? So let's do this. So I'm going to go to the dollar index, and I've created a template that mimics what the squeeze does. And let me do this. Let's blow this out so we can see this. So what is this concept of the squeeze? So first of all, the red lines here represents our outer bands of our Bollinger Band indicator, our standard deviation. And the blue shaded area is the area between the two bands. The dark blue line represents the Keltner channels. And so the theory of the squeeze is that when the bands of the Bollinger Band come inside of the Keltner bands, that's when the squeeze is on. That's when volatility has gotten to a very low period. Now, in order to create the squeeze, you have to have both bands inside of the Keltner channels, not just one, but both. So this Bollinger Band condensing, so you can see it again here. You can really see it here. We have the outer bands are way outside the Keltner channels, and here you can see that our bands are narrowing, right? That coiling action. So somewhere around in here, it looks like we had that squeeze go on. So let's draw a line right up. Looks like right about there is where both bands go inside of the Keltner channels. So then what happens is, once we have the squeezes on, then we wait for the bands, the Bollinger Bands, to break outside of the Keltner channels. And in this case, we only need one of the two bands to do that. So let's look here. We can see that we have a squeeze that went on for a while. And then right about here, it looks like we had that band, right? Looks like right there, this band goes outside. And that would be the signal to us that they were going to release that energy, that pent up energy that was created by the squeeze. Now, the histogram below is an indicator of the direction of that the energy is going to be released. So, as well as it can tell us kind of the speed of the market, and also when momentum, for instance, here you can see here's that breakout, and we can use the histogram here to show us the speed and the momentum but also when the momentum changes, that would give us our permission to exit the trade. Now, looking at all of this, this might seem kind of confusing and difficult to interpret. And Carter has created a template that Barchart has adopted, and that is a lot easier to read and is a lot more actionable to the trader. So if you're following along at home, up here in the right-hand corner, you might see something that says templates or templates. And we're going to go into that. We're going to open that up, and we have bar chart templates. And there is the TTM, trade the market squeeze. And what we've done is created this template that recreates what I just showed you with those two band indicators. So I want to make this as easy as possible to simply read. And so what we do is we add some of these EMAs, these exponential moving averages. Now, they can be used for risk management, risk control, and we'll look at that a little bit later. But for the beginning here, I want to do is I'm going to just eliminate them from our picture here. And what we're left with is our chart. Now, our chart here is in candlesticks, but if you don't like candlesticks, you can always change the type of chart you want. And so here's just a simple bar chart. Now, remember those red lines that I drew that indicated where the Bollinger Bands were inside, where the squeeze was on? Well, notice down here in our histogram is a little red dot. This is created by the conditions of the Bollinger Bands inside the Keltner channels. And that's the setup before the release, before the squeeze fires. Now, a red dot can be just one red dot, that'd be setup, or it could be, in this case, several red dots. But we only get one squeeze fire for each squeeze play, and that would come with this green dot. So that would be the point when the Bollinger Bands are moved back outside. And notice that the red line that I drew here was an identification of where that occurred. So we can use the histogram now. Is going to tell us what type of position to take. Above the dotted line, if the histogram is above the dotted line, that's going to tell us that we're going to take a long position. And below the dotted line, as you can see here, was a squeeze setup, and the histogram is below. That would be a short. So we're going to talk about this using the squeeze. Again, identifying the squeeze, we're going to look for periods when that Bollinger Band is inside the Keltner channels, and indication of a low volatility. And a potential squeeze is presented by that red squeeze dot. That's the setup. Then we're going to wait patiently for a confirmation. We're going to wait for that green dot to fire, and then use the momentum oscillator to confirm that signal breakout. Now, what I would say here is don't jump the gun sometimes. You will see that the histogram might flounder above and below until we get a green dot. I know some traders will jump the gun if you see, let's say, a downward histogram before the green dot. Just be careful. You need to wait for that confirmation. Now, taking a position once the squeeze is confirmed, once that green dot is indicated, we're going to take a position in the direction of the histogram breakout. Again, above the zero line, we'll take a long position, and below, we'll take a short position. Now, we're going to talk about risk multiple times throughout this session, and we'll get back to it in a bit about initial risk. But Carter does offer up several techniques depending on what time frame you utilize the squeeze in. Now, Carter does believe that the squeeze is optimal at 1 hour and 2 hours on intradays, but in his book he does mention 5 minutes multiple times, and that dailies, weeklies, and monthlies are probably where he would do most of his analysis. And he suggests a case for using weeklies as the best of all the time frames. Now, even if you don't use weeklies, or you think weeklies is too long of a time frame for your own trading system or trading plan, Carter will say to you that pay attention to weekly squeezes, and if it's firing, don't take a smaller time frame trade that fights or is against that weekly squeeze. In other words, the weekly squeeze is going to give you the permission to go either long or short, and then when you're in these smaller time frames, 5 minutes, 1 hour, or 2 hours, or even dailies, then you only take those squeezes that are in concert with a weekly firing. Now, sometimes weeklies won't be firing, and then you would be on your own risk management. But the concept that Carter employs is this multiple time frame analysis. So again, Carter offers up several different types of rules, and I'm going to give you some of my own rules that I use as well. So first one is on initial risk. We could measure the high or the low of the bar that has fired. In other words, the bar that's going to put us into the market. And what we're going to do is we're going to set our stop opposite of the direction of the trade. And that should make sense for most traders. But that is one of the ways we can look at initial risk. The other thing we can start thinking about as the squeeze play is going on, that typically the squeeze fires for about 6 to 10 bars, whatever time frame we're in. And when that histogram starts to change color or starts moving back towards the 0 line, this would give us permission to start considering about exiting a trade. Now, Carter recommends that exit a trade when you have 2 bars in the new color. For example, if we have a squeeze that fires where we have a light blue, that's would be indicated a long position. We're above the 0 line. He recommends selling if we get 2 dark blue bars. And if we're below, then we go from a dark pink to a light pink. So let's go back to our dollar index. I'm going to blow it back out. And so let's look at that initial risk. So here is the histogram has been above as we get our green signal. And then what we can do is now use that candle that enters as a trade as our risk. And so Carter would say something to like, if price closes below the lowest point of the entry, that would be a sign that you probably want to be out of the trade. Or you follow his system and then you wait for, on average, 6 to 10 bars and wait for that 2 consecutive darker bars, or in this case, darker bars, where it changes colors. Now notice in here, this is count how many bars this was. 1, 2, 3, 4, 5, 6, 7, 8. So you got an exit signal on the 8th bar, which is right in line with the Carter's theory. Now, the other thing he says is as we move forward in time, we can start looking at the highest bar in our movement. And if price closes below the lowest point in the long or above the highest point in a short, that would be an indication to exit a trade. For day traders, Carter will tell you that you could look at something like a 2 times risk of the 14 period ATR. In other words, we're going to enter into a trade, and then we're going to set our stop based on 2 times the 14-period ATR. Now, if you're not familiar of where to find that type of information, under technical analysis, here it is, right here, technical analysis, we do offer the average true range, the ATR, and we do have a 14 period. So this is the daily period, but you could put this study on, let's say, an intraday chart, and then that calculation value would come up, and you could use that as your 2 time. So in this case, for the dollar index, Carter say from the initial trade, you would risk 2 times the 14-day period, which in this case would be about $1.20. One of the things that I use is I use a half ATR. I might tighten my risk up a little bit more, and I use like a half ATR, but I use that from the low price, not from the entry price, as Carter would suggest. And it kind of works out about the same. You take a little bit less risk. And now this is important for some folks because the part of this system is there's no pre-targeting goal, right? Carter just lets you ride out this wave of the histogram. In other words, just ride the trend until the bend at the end. So for some folks who need structure, this system that I'm going to suggest to you of using half the 14-period ATR from the low or the high of the bar that enters you in, depending on which direction the trade is a good way to set risk. Plus, then what we can do is we could set a goal, a targeting goal, not necessarily where we're going to get out because we're going to let this system play out. We can set a goal of 2 times the 14-period ATR. And that would give us, or you could use 1.5, I guess, that would give us somewhere between a 3 to a 4 times risk reward ratio, which would be a much more desirable trade as in part of a trade plan. All right, so let's go back to Carter's. So let's look at those 2 examples. So here we can see that we got a firing. We would get into the trade here. Probably someone's right here. Here's the close. And, we got about 6 days into the trade, and then we got our 2 blue boxes. And this would be an indication to us, based on Carter's system, that we would exit that trade. So that would put us an exit out right here. Now, one of the nuances that you could do, and this is something that I will mention, is if you are looking at these 2 blue bars and you look at the past previous up bars, if this second bar is not below this bar here, that could be an indication you could stay in the trade. Now, remember the other things that we left off on our template was we left off the moving averages. Let me just change the bars here so it's a little bit easier to see. One of the rules you could use here for risk management as you're in the trade is you can use these moving averages. So what we would do is we would exit the trade, even though the bars tell us that we should, we would only exit the trade if price closes below one of these moving averages. Now, which one would you use? Well, that'd be player's privilege, whatever one suits your risk. So in this case, if we use that system, we would have been into this trade all the way up to this first moving average here, or this second one here. So we would have been in the trade a lot longer. But if we look at this trade, you can see that here we got our 2 blue bars. Again, this blue bar is below the 2 previous ones. That would be a good indication that momentum has changed, and that Carter would have been out on this bar. Now, one of the things he does say is you could wait for price to break below, the high or low of the peak bar in this move, which would have been this bar here. So, then again, that would have run maybe on this bar here, or we could use our system, which said that we'll use the moving averages. And again, that would be on this bar. So using the pure system of the 2-bar analysis, we would be out on this bar. And in this case, Carter's system would have gathered more profit than that of the moving averages or the high and low bar example. All right. So before I move away from the dollar index here, is I like this as a great example in what I believe is an important market for us to check for those daily and weekly firings. Now, why is that? Well, because the dollar drives or is an influence on multiple markets, right? From equities to currencies to commodities. So knowing if the dollar is in a squeeze, it's firing in a squeeze, that might lead you to take certain trades or potentially also keep you out of some bad trades based on the dollar's relationship to the market that you're actually trading. All right, so let's look at another example. And this is that example of multiple time frame analysis. So I've gone to corn here, and what we see here is we got a squeeze setup, we got the firing, we have our histogram below. It tells us we're going to take a short, and this happened around, looks like April 24th, and the trade continued on until it didn't give you an exit until May 4th. So a short from April 24th to May 4th. This is the daily time frame. But Carter does say that you can effectively use the squeeze in lower time frames. One of the time frames he does like is the hourly time frame. So that's what I've done. I've gone to a 1 month look back on a 60-minute time frame. And I want to go back in time a little bit. And here we can see we got a squeeze. This is around May 1st. Look up here, May 1st. And we got a squeeze that gave us a buy signal. Now, what we can do is we can eliminate some squeeze plays that are in contradiction to our higher time frame analysis. We just looked at the daily. The daily on May 1st was still in a squeeze firing to a downside trade or a short trade. Here at the lower time frame, the intraday, we're getting a positive or a long squeeze. But notice that the explosion or the effectiveness of the squeeze is not much of a price movement. Matter of fact, I think if we did our analysis here, I think we would see that by the time we would exit the trade or gotten the signal to exit the trade, it looks like we would have probably just broke even or maybe even lost a little bit of money. That's because this trade is in opposition of the higher time frame analysis, the importance of using multiple time frame analysis. And that also could also be because of our weekly, and where Carter believes weekly is where we should start all of our analysis with the squeeze. And you can see that as of April 10th, April 17th, we have been in a firing on the weekly basis for a short squeeze. In other words, a downtrending market. And that at this time, now all intraday squeezes, we will only look for the short squeezes and not the long squeezes because they are opposite of what is going on in our two higher time frame analysis, dailies and weeklies. All right, so another point that Carter uses is we can go to other technical analysis to help us find some greater candidates. And one of the ones that Carter believes in is, what I'm doing is I'm putting up gold. And those of you who are not familiar, if you use the *0, that'll put you in the most active trading futures contract, and that's currently is the August contract. But what it does is it'll put you in a nearby chart, so when you look back at time, you can see what is the most active trading month at that time. So here I'm in a weekly time frame for gold, and one of the technical analysis that Carter says that we can add to help enhance some of his squeezes is using something called the ADX, the average directional index. Now, which is kind of interesting, this is a unique take because the ADX is usually used to confirm a trend. Usually we want to see a rising ADX as a kind of a sign that a trend is developing. It could be an uptrend or a downtrend. It doesn't matter, it's the way it's formulated. But Carter, what he wants to do is he doesn't care about the plus or minus DI lines. He eliminates them. He just wants to know what the ADX line is. And so his thought is that he wants to find squeezes where the ADX is at a historically low level. And why is that? That's because these are the ones that typically are the most explosive when the squeeze takes off. So here we are in gold, and we got a squeeze that is set up. And notice that our ADX line here is on a very low level, historically low, compared to over, let's say, the last, what is this, about 10 years. Now, just for reference for you, anything below 15 in the ADX will get into a low category, but I have seen some below 10, but something below 15, and this one looks like it's around 12. So these ones are going to be those squeezes that he looks for because he knows that when the market breaks out, right, it's breaking out of a trendless market. And you can see prior to the squeeze here, we kind of have a trendless market because the ADX is telling us this is a trendless market. And then we get a breakout, and here we can see the breakout was around 1850 and the high was around 2000. So, you got a $200 move out of this trade. Now let's go back to look at this squeeze here. Again, here we have a squeeze setup that gave us a long trade, but our ADX is high in its range, which means that this market, even though the squeeze was created, it is actually in a trending market. In other words, maybe the energy that has been driving the trend has already been released. And yes, the squeeze worked, right? Here's an entry that gave us an entry somewhere around, I think it was 13 and a quarter. Yeah, right about there, 13 and a quarter. And, it did run up to about $13.75 at $50. That's not too bad, but it's certainly not as explosive as the $200 move. So one of the things Carter does use when looking at weekly squeezes, he uses this ADX formula, and he only likes to look for those really good setups where we get a low ADX with our potential squeeze analysis. All right, so let's move on from futures and currencies. And really, Carter created the squeeze for these two markets. But he also goes on to say that it's very effective as well in equities. The difference is going to be our TAC. And where in futures or currencies, we might just buy or sell the underlying contract. With equities, what we're going to do is we're going to play the volatility as well as that directional movement. In other words, we're going to trade options. And Carter offers up 3 option strategies. One, he wants to buy an in-the-money call with a delta of 70. Now, why does he do this? Well, because it has 2 purposes. One is we're going to get that leverage from trading options, and we're going to be able to take control of a large amount of shares without putting up that capital to actually buy that particular stock. And the second is he uses that 70 delta to help with his risk reward analysis and help him to manage risk. The second strategy he uses is he sells an out of the money put below our, in this example, we're going to use our EMAs, our moving averages. Now, again, which one we use or which strike we choose will be a player's choice, but we're probably going to look at a shorter dated option. And then strategy number 3 is that he looks at buying an at the money spread. In other words, if I'm in a bull or an uptrend, he's going to look at a bull call spread. If he's in a downtrend, he's going to look at a bear put spread. And sometimes Carter will actually employ all 3 of these strategies at the same time, really kind of leveraging. Again, if he can find one of those trades at the weekly level with a low ADX, then that would be an ultimate trade for him, and he would employ all 3 of these strategies. So let's work through the 3 strategies together. So the first one is he's going to buy an in-the-money call with a delta of 70. And why do we do that? Well, let's look at that. And let's go to the IWM. So if I buy a call with a 70 delta, what this does for me is, first of all, the leverage part for options. So let's look at today's market, and I can see that let's go out. If I'm gonna buy an option, I want at least to have some time. I don't want to worry about decay. So let's look at next month's expirations, the July. This gives me 44 days, so I'm probably not going to get a lot of theta decay as of yet. And so we can see a 70 delta right now is right around 180. Now, when we put this trade on, we got that signal back here in the IWM. That was on this day here, and we can see that the IWM was trading 179.50. So we're going to look for a strike at a much lower lower value based on where the current price was at that time. But let's think about this. If I go to a lower strike and I have one of these higher deltas, for instance, let's go to, here's a 175 strike. And what I'm going to do is I'm just going to show you something here. I'm going to go back in history a little bit. And that entry date was on June 5th. And you can see that on June 5th, I'm on the wrong expiration, excuse me. So on June 5th, our option was trading somewhere between $9.59 and a low of $7.50. But at the end of the day, when we got the squeeze indication, to give us permission to enter a trade, the price was around $8.24. Well, the value of options is I can buy one option here for $824. That'll allow me to take control of, in theory, 100 shares of the IWM. Now, we saw on the chart that on that day, the IWM was trading 179.50. In other words, 100 shares would have cost us $17,950. So I can take control of an asset that's worth $17,950 for $820. That's the leverage of options. So that's one of the benefits. The second is knowing that my delta, now in this case, the delta on this particular day was 67, but just work with me just for demonstration purposes. Delta tells us that how much that option is going to change as the price of the underlying changes. And so where every $1 change in the IM is going to change this option by in this case 67 cents, but if it was a 70 delta, it would be a 70 cents. So remember our half ATR theory? Well, let's go back to the ETF, go back to our technical analysis, and my 14-day period ETF for the IWM is around $3.53. Let's just make it easy for us. So we'll have that. That's about $1.75. We'll go back to our chart. And here's the day we entered. So 179.50 minus 175, that would be, below 178. At that point, if the IWM got below $1.78 over the next day or so, I would exit that trade. But because I have a 70 delta, that 175 risk that I'm going to allow myself to take, $1.75 times my delta, 70, means that I'm really only risking $1.22 in this trade. And basically, if I bought it at $8.25, I'm going to get out at $7. So I'm only going to lose, about $1.25. Now, if I use that technical analysis theory of half risk ATR and a 1.5 to 2 times ATR for a target to set up this trade, that would be a good trade. But let's just look at this trade as is. So here we have a breakout. Again, that's what Carter's helping us identify, a breakout of a range. And where do we see the next level of resistance? Well, new resistance comes from old support. And this little blue line represents an old support level, which would be an area of resistance. And that would be $7 above where we would have entered into the market. Well, you could do the math in your head, right? $7 times a 70 delta, which would be $4.90. So we're risking $1.25 to make $4.90. I think any one of us would line up to take that trade, knowing that the probability is super high because of the squeeze setup. But let's look at current options prices. And we were looking at the July 21st, and we want the 175. And let's go to his vowels and Greeks because we'll get a theoretical value. And the 175 right now, theoretical, is worth $14.17. So that trade would be up $6 in just 2 days. Not a bad trade on a $120 risk or a $1.25 risk in terms of our delta. And, we're only 2 days into the squeeze. We can anticipate if momentum is going to continue here, that we're going to get another, 3 to 7 days. And that could set us up to the next level of resistance, which looks like around 190.150. And then, what we could be talking about is a 10-to-1 winner here instead of a 4-to-1 winner. All right, what would be the second theory behind trading equities with the squeeze? Well, Carter says that you could sell an out of the money put. Now, again, which ones are we going to use? Again, I think we can use this risk management that I showed you using the moving averages. Either any one of the lines would be a great area to start looking for strikes below. But, let's use the lowest one, right? The farthest price has to travel. In this case, on the day of entry, our black line here, our 4-day expected moving average was around 177. So let's pick the same 175 strike. Now, what I might do is, instead of looking at a monthly one, where I don't worry about that much about decay, I want decay. I want that rapid decay. So knowing that the squeeze is only going to last 6 to 10 days, So maybe I'll look at an option that's going to expire 6 to 10 days out. So some of you that this is kind of how you can use those DTEs, those zero DTEs, those of you who are trading those intradays, how to do that. But let's say, the June 16th, right? 9 days out. And the 175 put. Now, what I'm going to do with this is I want to kind of recreate this for you, is let's go to time and sales. And we're doing puts. We're looking at the June 16th. We're looking at a 175 strike, but we want to see what that strike was trading back on June 5th. And this is another way to look at price history. And you can see that, throughout the day, it was trading just a little over $1. And at the end of the day, it was trading around $1.15. So today, the 175 put that we would have sold on the squeeze is only theoretically worth about 23 cents. So, would be up almost $1 on this one. And that's not too bad considering we're only 2 days into this trade. Now, the other example that Carter talks about is creating a bull call spread or a bear put spread. In this case, would be a bull call spread. Now, this one's going to be a little bit more difficult to recreate, but down here under your options, we do offer a screener that allows you to do bull and bear put spreads. And again, I probably would look one that has a little bit more time in it. And so what the techniques, I could scroll through, there's hundreds and hundreds of examples in here. What I could do is go in here in the screener and I'm going to choose that strike that is at the current price. And so at the current price when the trade was put on, it was around 179.5. So, I picked that strike 179. And so I'll go into the filters here and I'll just do something like this. I'll write leg and strike leg 1. And I said that, we wanted to be somewhere around 179. So let's pick, somewhere between 178 and 80. And we knew that target we picked up there was around 186 and the other one was around 191. So we could look for, that combination, right? Here's a 179, 192, here's a 180, 191, Now, again, these are based on current prices, what's going on today. And, your max risk here in this trade, for instance, would be $6.80. But remember, we're going to use that risk management tool, that delta tool. Now, an at the money call spread will probably have a net delta of probably 35, or around that range, around 35. So, we would not be risking the whole $6.80. Once price got below that exit point that we demonstrated before for the 70 delta call, we'd be out of the trade. But now what we're risking, instead of risking $1.75 as we did the half ATR, we're only going to risk, a 35 delta, right? Our net delta. So that means, we're probably only risking about, what's that, about 50 cents, 65 cents. So in that range. So not a lot of risk on this one. But again, when we look at this trade, think about if the trade starts working for us, and not only are we going to get that price appreciation that's going to work it, but also think about, we bought in low volatility and now prices are moving explosively. Our volatility is going to increase. And so all of those bull trades will appreciate with an increase of the volatility. Okay. So Gene, I see a lot of questions that have popped up and I want to try to get to a lot of them. But I do have a couple hacks I want to show folks. So give me a moment here so I can kind of read. So James Walter says cat is now in a daily squeeze. Okay, James, folks, you can, if you have time, you can go and check that one out. Scott asks, is the 6 to 10 apply to all time frames? Yes, he says that the squeeze tends to play out in all time frames. So Ari asks, they don't have success in Forex. And then again, Ari, I think there might be an issue. I don't know what time frames you're using this in, but maybe because, from what I know from a Forex is, you really should be working in higher time frames. So Ari, if you want, send me a question through support@barchart.com and tell me how you use it. I would probably suggest is only use the weekly squeeze, and then if you're using intraday or daily trade setups, then only take those trades that are with the weekly squeeze. In other words, you're limiting the amount of times you're taking trades, you're waiting for it. So Zach asked, how would you apply this if you were in a market, in a down market? It's regardless of what the market, we don't care what the market is going to do. It's all about the squeeze. So if the squeeze came on today, matter of fact, the IBM trade that excuse me, not the IBM, the IWM trade happened to be on a down day, but the squeeze fired on that day. So here, somebody said Caterpillar. Actually, it fired 3 days ago. So yeah, so Caterpillar is definitely on the run. All right, so again, we're get this issue about the red and green dots. Remember, the red dots are just telling us that the Bollinger Bands are inside the Keltner channels, that the setup is being created, the conditions are being created, and that we still need to wait for that first green dot after the last red dot. And so sometimes there's another question here. Sometimes there's somebody will say, well, I'm looking at, an equity or something, and I don't see, any setups for a long period of time. And that it could be just because, the volatility hasn't gotten squeezed, right? So here's the weekly on the SPY. You could see that it was, you know, years before we got the proper setup. And it was only just recently, back in April, did we actually get a squeeze setup that would have set you long on the SPY. Okay. All right, Gene. So I'm running out of a little time here. If I didn't answer your questions, folks, please send them along to support@barchart.com. I know a lot of our support guys who trade use this methodology, and I'm sure those folks can answer it. If they can't answer those questions, they'll pass them along to me. So I do want to show you a couple hacks here, or one cool hack. So a lot of times we get in support is asked us, is there a screener that shows us the squeeze instead of, let's say, looking at, every market or every trade that I want to do and just look for those that are taking squeeze. So no, we don't have a screener right now for the squeeze, but I want to show you kind of a hack. So what you can do is you can look at any of your watch lists. You can go into, for instance, like in stock here, for instance, like day surprises is a great place upon to look for. So here's bullish surprises, but we also have bearish surprises. And then another spot that I kind of like to fish pond that I like to fish in for looking for these squeeze trades in the investing section is this EMAC buy signal. Typically on this one, you usually find those stocks that are in that consolidation or have made a large movement into a bottoming cycle where you don't get a lot of price movement, and then all of a sudden the EMAC that crossover would give you a bullish signal, but these are typically where we're going to find those squeeze candidates. So what you do is you go into flip charts, and up here it says multiple charts. And so what we're going to do is we're going to turn on the 4 grid, and then we're going to go to the templates, and we're going to turn on the squeeze. And I know this is difficult, but here's what you can do is you can scroll through 4 stocks very quickly. And all we're really looking for is that red to green. In this case, AbbVie here today looks like, or AbbBev, I think this is a beverage company in South America. You got that squeeze indicator. So you could go right to that market and look at it. You could start seeing. Now, just be careful. A lot of these, stocks, maybe one of the things you could filter out is, over the counter stocks. So, not a lot of these might not have the options to trade on them. You might have to trade. And I looked at this one. This one doesn't really have a lot of options trading on it. But then what you do is you just pick the next 4, and you can continually to look. So none of these are squeezed, but here's one that is setting up for the squeeze, right? We got the red dots. We just need the green dot. So what we could do is create a watch list, right click, right? And create a watch list, and then add that stock to my squeeze watch list. And then what I'll do is every morning I'll look at those candidates that are inside of my squeeze watch list and say, okay, this one has got the setup. Now I'm just waiting for the green candle to take the trade. So I know it's a little bit more work, but it is a cool hack, and it's an easy way to look at a lot of stocks in a very quick manner. And you can go through, if you're looking at 4 stocks at a time, boom, right? Is it there? Is it there? It's not there. It's there. It's not there. And you can do this on, multiple watch lists or data pages. Okay. All right. So let me give you a takeaway here. So the squeeze is an indicator that can be complicated because of all the different components, but because what we do with Barchart here, our template makes it very easy to read and to react. The reader need to only wait for the squeeze to fire. Remember that green dot after our red dot or series of red dots, and then ride that histogram wave to profitability. How you exit the trade? Well, I give you multiple risk parameters to decide when to exit a trade. Now, remember, there's no such thing as a perfect indicator, and risk management is paramount. So, but traders can rely on this indicator's probability if we use that multiple time frame analysis. In other words, using the higher time frame to give squeezes, to give us permission to look at those lower time frame setups. Okay, Gene, that was a lot, right?
Yeah, John, you covered a great amount of information, including that last little tip of how to do your own kind of screening for the TTM squeeze. Great tip. Yeah.
Okay, so what do we got? Well, next week we've been kind of on off. We don't have a webinar next week, but we will have one in 2 weeks' time. So if you want to sign up for notifications, we'll let you know when that next one is. Again, we're sort of in development. We're doing a lot of planning right now. So we'll be on for we're off next week, then we'll be on for 2 more weeks, and then we'll be off for 4th of July. And then we'll have a nice little stretch through the end of the summer. So this is where you can find. Now, all of our webinars are archived, not only here on our webpage, but also on our YouTube page, and you can watch those. And here's John Carter's squeeze. And if you go to that up here, you can see where it says download slides. And this is where you find the slides that I showed you today. Okay, and also some related other webinars that we've done in the past that relate to the subject that we talked about today. Okay, Gene, thanks so much for another great session. I appreciate your help. Folks, please be safe out there. The best of health and the good. of all trading.